I will shortly introduce who's with us over here. He worked with a lot of banks, with Royal Bank of Scotland, with Bank of America Merrill Lynch. He's here in his capacity as senior advisor to International Capital Market Association and the chairman of the International Capital Market Association's Investor Bail-in Working Group. So what better fits to be here? And we are very happy to have you, Tim Skeet.
Well, look, I'm not one of the evil bastards. Just for the benefit of everybody's information here, I've always been a client-facing person, which means I'm not a trader, and I never sold nothing to nobody that blew up subsequently. So I just make that absolutely clear, particularly to Sir Paul, who's sitting in the front row here. The importance about the International Capital Market Association is that we work with regulators to try and ensure that the debt capital markets work efficiently and function properly. And we bring people together to try and work with the regulators to make the regulations work. And that's something I'm hopefully going to be talking about in the context of bail-in. And by the way, I agreed with the speaker's comments about the fool's gold coconuts, which are a very interesting instrument, and I hope we talk about them a bit more.
We will do so, and now I'm a little bit scared for giving you the microphone, so I hope we have all the discipline to hand it back. From Denmark, he have been visiting professor and guest lecturer in the US, in Canada, in Israel, in France, and in the UK. He's now here in his role as full professor of international commercial law at the Copenhagen Business School. Thank you for being here, Georg Ringe. Then we have... You don't get the microphone right now. Now I will start with a first round of questions afterwards, if you allow. We have here from Treurenberg, so just 5 minutes to go from here, from the new institution, so from the heart of bail-in, the head of unit of resolution from the European Single Resolution Board, Gaëtan Viallard. Thank you for being here. And then we have, he is with Finance Watch. He studied in Berkeley and in Innsbruck, finance and law. He worked as banker as well with Deutsche, with Unicredito, with Citibank, and now you're the senior policy analyst caring especially with banking regulation and the issues we would like to raise. Christian Stiefmüller, thank you for being with us. So before we go into detail of what Avinash said, and before we go into judgments, if we agree or totally disagree that bail-in is not workable, I would like to have you one step back for a very short comment on why bail-in. Why haven't we choose another instrument? There are alternatives you mentioned already. Equity, we can think about bank structural reform, we can think about bailout, we can think about a lot of other things. So why it was bail-in? And I would like Georg to start.
Okay, thank you. Well, that's the key question, right, isn't it? I think the main purpose of bail-in is sound, and the main purpose is to, in a way, reintroduce market discipline for banks, trying to find a mechanism that we treat banks like any other company, right? So if any other industrial company fails, it is the most normal thing of the world in a market economy that those who have invested in this company bear the losses, right? And bail-in is trying to achieve exactly that for banks, for lack of a better other institution. So we realized Lehman and other examples that traditional bankruptcy for banks caused lots of hiccups, to put it mildly, and therefore, you know, as Avinash said, no taxpayer rescue, but you know, let the investors pay for it, and that's, I think, the main objective. The second, more recent objective that I see is also bail-in is also supposed to carry some of the important work that we normally associate with stemming market panics, right? So bail-in also, if done early enough, has also the power of avoiding any market panic up front. So I think this is the overall picture of bail-in, and I'm slightly more optimistic, but we can go into detail later on this, that these objectives can be achieved.
Yes, thank you for staying in this first a little bit neutral in the first round and then go into the real positions. Gaëtan, so why bail-in?
Well, I think that already some elements have been provided clearly for the reasons to implement bail-in, and there are these elements, in particular the fact not to have the taxpayers to contribute is clearly one of the key elements. Also to have in mind that behind all this resolution issue, resolution, it was not a word in many languages a few years ago. Even in French now we say resolution, and it's quite new. Why this resolution thing has appeared, and why this bail-in also, even in French we say bail-in? Because apart from this protection of taxpayers, there is also the idea that there are some elements to protect and for which there is the need to find some funds to make sure that there is the continuity of some operation, that there are in the banking sector some critical functions which we cannot continue to leave without them working properly, and there are some activities on contrary which are not critical functions and for which there can be no need for financing. So there are the necessity to protect these critical functions, and also perfectly aware of the challenges in the implementation of bail-in. Also to try to avoid contagion. So clearly one of the things which must be kept in mind is indeed who owns these bail-in instruments and what are the eventual domino effects of applying bail-in on these people. So bail-in, but having in mind the consequences of having bail-in to protect some key activities for not only the financial sector, but really for all the society.
Thank you very much. So we have already a list of arguments. We have the distinction between companies and banks, which makes a different resolution regime, well, not evidently necessary, but which brings the idea. We have to prevent escalation if it works. That people are getting nervous. We have the protection of taxpayers. We have the continuity of the critical functions. Christian, is there anything, when we bring in a little bit the alternatives as well, why bail-in and why not the other things?
If you allow, I would quite like to tie this in with what has been said previously by our two keynote speakers. On the one hand, we need to really sort of take a step back and look at what the main lessons were after the crisis. And as Paul sort of said, there is clearly a recognition that at the time when the crisis hit, the banking system was over-leveraged and undercapitalized. And secondly, also from the crisis, there was a recognition that too big to fail institutions and the too big to fail concept had to be ended. Now, three broad answers sort of were brought into the mix. One is higher capital adequacy requirements, the whole package of Basel III and CRR CRD4. Some progress has been made, but as Avinash Persaud just explained to you, there is a broad body of opinion that what has been implemented so far in terms of equity underpinning is not enough. The second point is bank structural reform, something that has been alluded to several times today already. Again, limited progress on that topic. And then thirdly, really, resolution, bail-in, as the third approach, and perhaps even the last shot at solving the too big to fail conundrum. So these are the three alternatives, and we basically feel that today we are very much sort of faced with making bail-in work because perhaps the other two options have not really been implemented properly.
Thank you. So for all the panelists, please just use it as an ice cream and have it real close to your mouth. Tim, starting into this debate, which Avinash has opened up. Do you agree? Because now we have some arguments why it was chosen, but he said it's understandable why it is chosen, but it's still not working because he gave us a lot of arguments. So would you agree that bail-in is not workable? Thank you.
I think the answer is it is and it isn't, but there's quite a bit more work to be done, and I think that was the message from earlier from Sir Paul. From an investor perspective, and my committee is an investor-only committee deliberately because we don't want the issuers influencing what the investors are thinking. The investors accept the principle that they are subordinated. I think the world has moved on from being in denial about where we're going. The United States has operated this kind of system for some time at a smaller scale through the FDIC. But I think Europe has taken a while to come around to it. We're there now. The question for investors is simply this: how do you price risk? What Avinash was saying is there's something wrong with the pricing, particularly of the cocoa bonds. And investors will tell you, because on my committee, in fact, we have a type of being that didn't used to exist in the old days when Paul was looking around for someone intelligent to talk to about bank credit, and he could only find the equity investors who knew anything about it. It's only in the past 4 or 5 years that the investors have woken up to the fact that they need a certain amount of technical knowledge to understand banks on the fixed income debt side, and arguably more important than on the equity side. These people do now exist. They've been recruited from rating agencies from across industry, and they're now doing their work. They will tell you they can't price cocos properly. We can answer why investors bought them. Well, in the absence of any yield on anything, they're almost forced to have to do that. And you may say this is a side effect of government policy, that if there is no yield and investors need yield because they have to pay our pensions and insurance and all the rest of it, that's a reason why they've ended up buying these things. But more to the point on bail-in, investors will tell you they still don't have enough information to properly price the risk, even in normalized markets. And that's one of the biggest challenges. So what we're saying to all of the regulators now as they come together is help us to help you on transparency and openness, address the real risks that investors now being expected to take, which they didn't have to take before.
But just a very short follow-up on that. What is the real problem to price the risk? So is it a lack of information given by the regulators, or is it in the product itself that makes it difficult?
Again, it's a little bit of both because we're in moving markets. It's not clear in every European jurisdiction, and I think Sir Paul was referring to this earlier, exactly how the subordination is going to be created. So we don't know yet what the French are doing relative to the Germans, relative to the British, and so on. That's one issue, and there are technicalities. Investors want simplicity, and they want consistency across Europe, and that's normal. Make it understandable. Some jurisdictions are talking about creating new fangled instruments with different levels of subordination in order to get an instrument that seems to work. Again, it's a level of complexity in an already complex world. That's one level of problem. But where is the point, and George Ringe's paper actually refers to this, where is the point of non-viability? At what point in time do the regulators jump in to bring a bank to heel and start bailing people in? And what we do know is it's likely to be sooner rather than later. And the second question for investors is, well, what's the likely level of bail-in? How much capital is going to be eaten up at the point that the regulators jump in? At the moment, all of that is very confused and very, very unclear. And I think we will be looking for as much clarity as we can reasonably expect in the coming years on that sort of issue so that the risk can be priced.
So we will add on this a lot of other arguments which makes it difficult, but I would like to have some optimism on this panel also heard, if there is some optimism. So I don't want to just go for it if it's there. I had the impression, Georg, that you not totally agree with Avinash in his skepticism about bail-in, and that you see under special conditions a chance for that. Is that right understood, or is that wrongly?
Yes, thank you. I think the key question is how much do we trust markets to, to do it? And I think Avinash started off by saying you can't solve a market problem with the market itself. And I think there's a grain of truth in that. I'm still convinced that if done correctly, along the line of what Tim said, if you have a transparent, reliable and clear system, that we can at least help people understand the risk. And the first instances of it's been used, the first times it's already now, suddenly there is bail-in use. Suddenly everyone understands, oh, these instruments are actually risky, right? So that helps the price formation and all of this. So I think it's a gradual process. And I hope, so on the optimistic point, that the more and more we're getting used to it, right, that we won't get used to it in a big crisis moment, hopefully, but we get used to it over time with some minor instances in Italy and other situations right now, that gradually the market will understand what these instruments really are, and that then if you design the system properly, if you give the resolution authorities proper power to intervene early, to intervene with all the power that they have, that these instruments can address the issues in an adequate manner. But I address this in my paper that was mentioned with a number of caveats. So I think the system right now is far too complicated and underfunded and all of this. But I have some silver lining on the cloud here. I think it could be done properly.
Gaëtan, at least you must defend this system as you are a part of it.
I don't know if I defend the system, or at least I try to bring some additional elements in the picture. No, clearly in the last years and months there has been a framework which has been elaborated. There has been the implementation of these rules and common rules inside Europe with some deficiencies, some impediments for sure, but at least we have a more consistent framework around Europe, and in particular for the 19 banking union countries, with one authority which is the pilot if there are some measures to be taken, which is the Single Resolution Board, working closely with the national resolution authorities. And clearly, one of the reasons for this way to work, which may seem complex, is that indeed, due to the fact that the framework is not fully harmonized, there are many points in common but not fully harmonized, there is the need to have the experience, the expertise of the national resolution authorities to fully understand some specificities of the German, of the French, of the Italian law, for instance. But at least let's admit that there has been improvement in the capacity to handle these in the last years. A second point, also a second kind of impediment. Clearly, we are confronted. I think we are not talking mainly about the small banks, but mostly about GSIBs, large corporations, which have issued instruments throughout the planet with different legal system to be taken into account when there is the need to implement the bail-in tool. And also on that capacity, we try, on that subject, we try to solve the issues by cross-border cooperation between the authorities, by also having the power to include in the contracts some clause which will make sure that the instruments can be legally proof bail-in, and also to make sure that the owners of these instruments know if they read. I don't know if you read all the contracts, but there is some, at least in the financial sector, some, let's say, publicity, information around what we call in European environment Article 55 of the BRRD clause, to make sure that we have the possibility to bail in instruments, even if it is an instrument which is issued in Hong Kong under US law, etc., to Singapore investors, to make sure that even for that, BNP Paribas or Deutsche Bank instruments can be bailed in. Just last point to add in the picture. Of course, there is bail-in, but bail-in is not the sole element in the picture. We must be aware that it's one part of the full picture. There has been some improvement of prudential requirements. There has been an increase of the level of capital of financial institutions. We cannot deny that fact. It may be not sufficient for some observers, but there has been an improvement, an increase of supervisory monitoring by the supervisors. And also there is the work to tackle the impediments in general to resolution, and in particular for implementation of bail-in, by preparing all ourselves to that and to trying in anticipation to solve, to reduce, to mitigate many of the impediments for implementing these tools. All these recovery plans and resolution plans, it's not just to occupy some bureaucrats in supervisory and resolution authorities and to try to create the new functions in financial institutions. The rationale behind that is to be ready for next crisis and to have managed to reduce as much as possible the impediments to the implementation of resolution tools.
Thank you very much. So we have a plaidoyer. Just take the whole picture and get the early intervention, get the BRR, the double R, the recovery point of that as well. We have some elements you mentioned which we would like to debate a little bit more in detail, which is consistency and which is banking structural reform later on. But Christian, first of all, I would like to give you as well the chance for the overall agreement or disagreement with Avinash and the idea of, is it from a conceptual point of view the right way to go?
Perhaps sort of picking up on that issue that Avinash sort of very eloquently described. Sort of can more market sort of solve market deficiencies, and I think we share in that respect we share his reservations and concerns. So from that perspective, there is an issue clearly about the appropriate level of pricing. There is, and Tim has just alluded to that. So there are various reasons, and we might come on to them, why the market is not currently sort of pricing certain securities well and sort of not reflecting the actual risks in the way that would be expected. Another matter also that we see is the distribution of the risk, i.e. sort of by actually placing securities out in the market. Where do they end up? Who are actually the right people to hold these securities? And are these people who hold these securities capable of absorbing the losses? Again, coming back to Avinash's point, I mean, there are hedge funds out there. There are, in many instances, also other investors involved, and we have had a fair amount of public debate about bail-inable securities ending up in the hands of retail investors, of people, of savers, of people who effectively sort of came to hold these securities without much of a proper assessment of the risks that they actually were bearing up to the moment when they were bailed in. Now, this, from our perspective, is an issue that needs to be addressed. Gaëtan alluded to this from the perspective of investor protection, but presumably it goes beyond that. It cannot just be a matter of making sure that retail investors are properly protected. It is a general systemic issue where these securities should go and who is actually properly placed to hold them. Because otherwise we might just be shuffling systemic risk in a different place.
Thank you very much for this more conceptual starting point. Now we would like to go a little bit more in some elements of the question of, is bail-in working? like consistency. I mentioned that now we have a somewhat more consistent framework than we had before, but still we have national insolvency laws. We see just very recently that we have some working papers on the table that some countries already try to intervene to get MREL a little bit lower and to have this and this is excluded or included. We have the huge debate about participation of retail investors because we have different financial cultures, and let's say we have some sins in some member states who sold very massively bail-inable papers to retail investors, and now they come up to the point that they are maybe really get bailed in. So from a point of consistency, Tim, would you like to take the ball and talk about if this system that we have is consistent, or if we do need a much more radical approach in insolvency law or whatever, or what else is needed to make it real consistent?
Again, it would be ideal if we could harmonize insolvency laws across the European Union. We all know that that's a legal minefield. It will take a very long time to do that. In the meantime, I think the various authorities been working on the bailout or bail-in regimes actually have done a pretty good job getting as close as they can do. It's been an iterative process. So I think we have to show some level of acceptance and understanding that we can't create something as radical as this overnight. But there are still areas that need to be resolved. And I alluded to some of them before. Just a word about the controversy at the moment over Italy, for instance, or some of the legacy problems. My committee wrote to the ECB last summer saying there's €1 trillion of outstanding NPLs on the European banks' balance sheets. These are legacy unresolved problems, just at the point that the bail-in mechanisms are coming into effect. Are we really expecting investors to be exposed to the legacy mess as opposed to go-forward mess? And there is a debate. Many investors feel they shouldn't. They accept the principle going forward. They accept being able to price in future this kind of risk with greater transparency, but with this legacy of unresolved mess from behind. And of course then you can argue, do we agree or do we not agree with what the Italians want to do? That's not for my committee to determine, but we just observe it does need to be dealt with. We do need some consistency though going forward, and we need to understand what is the risk investors are taking. And can I just make one plea, because I think it's worth saying. I think this is the beginning of a debate about corporate governance around the banks. It goes beyond simply saying investors take risk where they didn't used to. We need to revisit not only the obligations of investors, but the rights of investors, the rights of employees at every level, and of customers, the government, the shareholders, but the note holders as well. I think that's a much bigger debate which we haven't yet got into, and maybe we can use this debate here as a starting point for that as well, as we fine-tune the bail-in regime moving forward.
I would, if you allow, take the second question to the both of you, because it's about investment calculation of risk and how to predict, which is part of your work. And the other question, unfortunately, Jakob von Weizsäcker, who is the rapporteur of the bank structural reform, so he knows best if it's still a chance to get this out of the parliament, so from the European side, from the very political side. But as you both are in EU regulation, and could you give us a little bit the relation between structural reform and bail-in, or let's put it other way, is bail-in working for very big banks if we don't have a Vickers or a Volcker or whatever rule? Christian, if you start.
I've touched on BSR before, and so I am actually quite I'm quite pleased for sort of Bruce thankfully bringing this up again. From our perspective, from our perspective, bank structural reform, in particular for the large, very diversified banking groups, the so-called systemically important groups, relates very, very closely to the bail-in scenario. One of the important issues that clearly a resolution authority, and I'm looking at Gaëtan here, has to consider when it is sort of drawing up the plan of how to deal with a large group in trouble, is what are the critical functions that this group actually performs, and how can they be safeguarded? And these are clearly sort of then the functions that need to be preserved to avoid sort of systemic contagion. So the issue of resolution and of structural reform are intricately linked on two levels. First of all, like I said, these critical functions need to be in a place. They need to be housed in an entity which then is transparent and can be dealt with by the resolution authority when it comes to it. So this is one piece. And the critical functions, or the functions of a bank, are obviously sort of very diverse and very different. Some of those functions are more critical than others, clearly, starting, for instance, with sort of basic payment services. If a large bank fails in its function as a payment service provider, obviously, sort of that is an infrastructural failure that can have extremely serious consequences. Others may be less critical than that. Perhaps if a bank is, say, a secondary player in the securities business. The other point is, in terms of resolvability, how does the structure of the group lend itself to the resolution process as such? I.e., where within the group is the bail-inable debt? Where is the capital? And can it be made accessible? Can it be downstreamed to where it is needed within that group? And I think Georg has some more thoughts on that, so I'd be happy to hand over to you.
Good. Thanks a lot for both of you for bringing this up. So yes, you're right, this is a topic very close to my heart, and I think it leads us to one point which hasn't been mentioned yet. One of the big questions is how to apply bail-in, and the favorite regime currently emerging, I think, hopefully emerging, is the so-called single point of entry strategy, of which Sir Paul is one of the architects, intellectual forethinkers. The idea is that if we have a large banking group, international banking group, should be a single point of entry at the parent company level, and only one resolution authority at where the banking group is headquartered should intervene and take responsibility for the entire group. The rival approach is the multiple point of entry, where lots of different regulatory agencies in different countries will intervene. And we could, I don't think we have the time to go into detail now, but the single point of entry has, I think, large benefits over the other one because it allows for a coordinated approach, saving lots of the costs of uncoordinated approach. But if we want to do this, and now I come to the structural reform, I think we need to look at the structure of banking groups. And the US banks have, for some historical reasons, largely been operating in such a holding company structure, which is some lucky coincidence. And the current debate right now in Europe is whether and how we should encourage European banks, encourage/require banks in Europe to organize themselves in such a holding company structure. And that would, ideally, I argue in my previous works, that would be the place of, the Liikanen proposal, the structural reform. We could ask, or at least encourage, or nudge, however you want to do it, European banks, for example, to giving them a discount in their capital requirements, right? If they organize themselves in such a structure, and make it easier for the home regulator to go in and take responsibility of the entire group. And that is, in a way, the optimal design for resolution, I would argue, because it also ring fences the deposits that would be in an operating subsidiary and would completely be unaffected by the resolution authority. So we would have large gains. It would effectively also serve as a deposit insurance to some extent, because retail investors wouldn't be affected by a resolution authority at all. It would, just one final sentence, it would of course require to have the bail-inable debt at the holding company level, right? So we would need to prescribe that the bail-inable debt is at the holding company level, which is in a way where the TLAC-MREL debate is going right now.
Thank you. Would you allow that, Sir Paul, you had something to add, as I understand?
I just wanted to underline how important this is, because I was talking about a risk at the other end of the spectrum, which is that no kind of subordination ends up being required at all, which I just think would be a disaster. But even the German model of statutory subordination within an operating bank, what it means is that it's the operating bank that goes into resolution. And you'll have all sorts of contractors on the Monday morning who are thinking, can I trade with a bank or a dealer or whatever, which is in resolution? Whereas if you have a pure holding company, the bank or dealer that you're dealing with, it isn't in resolution. It has been recapitalized by converting the internal so-called TLAC, using the jargon, and all the losses have gone up to the holding company. And the way the Americans are going to do this, I think the Brits are going to do it in a slightly different way. The way the Americans are going to do it is that they create a new holding company. So the bit that's in the resolution isn't an operating entity at all, and doesn't even have any continuing legal connection with the continuing bank. And I genuinely worry that, I think Germany has been fantastic on all of this stuff, but I worry that our continent hasn't got its head around this. And if I can make one other observation. Yeah, the Swiss definitely have. Axel Weber has been terrific on this. He completely understands how this works, and as you know, Credit Suisse, Wilson Irvin is essentially the co-author of the bail-in policy. At the Council of Ministers, they did discuss where the losses should fall. I mean, the Cyprus thing was a complete mess for reasons that I hope history will tell us. But it had one silver lining, which was that finance ministers and their staff around the whole of our continent were alerted to, oh my goodness, where are the losses going to go? And that's the background to depositors, and therefore deposit insurance agencies, becoming preferred creditors. And what I'm saying is that there should be three layers. These deeply subordinated, preferably in my view, structurally subordinated bonds at holding company level, then the other stuff, and then finally the preferred creditors, which are the subordinated depositors. And so I think the Council of Ministers did discuss this. They reached the right conclusion about preferred depositors, but they didn't go as far as saying we must have holding companies. And that's essentially for tax reasons. And I'm not sure I would have said this in office, and I haven't considered it very carefully, but I suspect that in the long run, that everyone would be better off if the governments just waived the tax costs of banks creating holding companies and shifting their debt from operating companies to holding companies. Sorry, for being so long.
No, thank you. Well, just to mention for all the ones who haven't spent the nights in the council building with the Cyprus issue, which is mentioned here, that was a week of everybody was a little bit scared because in that night there were someone missing in the room who said, well, this could be a problem if we go for the covered deposits now, and there was, by accident, there was nobody, but they, well, after 1 week, they knew it better. So there was a special week. It was in February 2 years ago. So, second question, and I will ask Tim to answer.
Yeah, we have quite a few questions here. Can I just make the comment that it's quite tough for a lot of banks in Europe and even the Canadian banks to go to a holding company structure. It's a major reorganization of their affairs on top of all of the compliance costs and regulatory costs they've already incurred. So again, if that's really the way the regulators want to push them, I think they need to be given some time to get there, but you know, that's another debate. I think it is worth saying the political dimension, I think, has been raised a couple of times here, and I'll come back to the ring fencing question, but where do we should have a debate, and when I talk about the whole business about corporate governance for banks, I mean having a debate about this. I think Sir Paul said the cost of this ends up at the doorstep of the households. The fact that we don't call them taxpayers means it doesn't go through the political process in theory. It goes straight to the households because at the end of the day, it's savers' money that is being bailed in. It's just not taxpayers' money, and there's a subtle difference. And people may tell you from a domestic perspective, if you're a UK bank going down, then you're bailing in international bondholders, not just UK taxpayers. So, you know, there's a big political dimension here, and we can't get away from it, and that debate really hasn't been had properly. But I think on ring fencing, just to come back, I think, to Bruce's point about Vickers, Mark Carney has not been agreeing with Sir John Vickers recently. It's interesting the UK is the only country to adopt the ring fencing in the shape and form that we have seen it. Liikanen came up with proposals. No one seemed to want them from the rest of Europe, and they're not going to do it. And I think it looks to me as if there'll be a little bit of flexing about because it's vastly complicated splitting up existing banks into different operations and figuring out which bit goes which side of which bit of the wall. And there are some very good operational reasons why you want some bits inside and other bits outside. So again, it's easy to criticize from the outside. I think Mark Carney's comment and the Bank of England has been quite sensible about this, and the Treasury Select Committee has made some quite good comments. So the UK is doing its own thing. I think they're beginning to say that the levels of capital are about where they need to be. I think that's the bottom line, an important item. And yes, they are going the holding company structure in the UK. But consistency from an investor perspective is what we want, something we can understand and that we can price. And I think we are getting towards it. I'm not trying to be negative, by the way, Detlef. I'm trying to be actually quite positive. But I think there is a lot more work for us to do. But let's do it in a very open-minded and a very friendly way, because I think we've all got a common objective here.
If I may just add 2 points. For consistency, I think that the private sector and supervisors or resolution authorities may may have the same kind of views. That's clear that more consistency, of course, between the different regimes is better. For the time being, we've got to deal with the way it is. Of course, if one day there is more consistency, it will be better, and it will be one of the impediments to resolvability to be mitigated. Also, just following the point on SPE. SPE is one of the ways to organize or to decide the resolution strategy, but one of the things also to keep in mind is that the resolution strategy has to be adapted to several factors, and among the factors to be taken into account is the place where the eligible liabilities for bail-in are, if they are at the top or if they are in different entities, the way the activities also are organized inside the group. And we see in Europe, for instance, that some groups have a huge concentration of activities, assets at top level. Some others have rather, distribution of asset activities in different legal entities. And these legal entities may be also the result of the legal framework of these the jurisdictions where these groups are established. And in establishing this resolvability assessment that we do, and in particular for GSIPs, because I think once again that we are talking here mainly about GSIPs, not about small banks. If we talk about small banks, there may be other things to take into account, and not for granted that it's to be under resolution. But for these groups which are established in many jurisdictions, there are some cases for which legal impediments to a cross-border implementation of the resolution strategy, it must be taken into account, and it must therefore be rather MPE or hybrid approach. So a systematic SPE approach for all the groups, despite the way they are organized, despite the jurisdictions they are established, I think would be difficult to justify. So there is the need to take that also into account.
Yeah, hopefully everybody gets fine with the abbreviations we use sometimes. Yeah, the jargon is, well, but otherwise we would need another half an hour longer if we always have to see Single Resolution Board or the big systemic risk banks and so on. So please forgive us for using it sometimes. Before I go second times into the plenary, I have the more practical point of view. You mentioned political pressure, Tim. A very honest question. Our colleagues, journalist colleagues, will close their ears for a second. That you can be very frankly, but I understand if I would work at Treurenberg with the SRB at the moment, I would be very scared that the moment that Ms. König has to be very tough, and your team, her team, you have to be very tough when it comes to just closer to a case, because what we see already now, where we don't see a case in forefront, there are already all kinds of interventions and all kinds of asks, demands, and so on. So you feel this political pressure, all right? You think that it's credible that we believe that you people from the SRB are tough enough to stand it?
Well, I think the framework has been created to have this independence and this capacity for the Single Resolution Board to make the work in first, an independent way, and second, in an expertised way, once again taking into account the work done with colleagues from the NRAs, for instance. The framework provides some cases for which the European Commission or the Council may oppose the scheme which is prepared by the SRB. But really the framework explicitly mentions the kind of cases, use of the fund, for instance, the public interest test, for which there is the possibility for Commission or Council to oppose. For the rest, well, I think we are working with the NRAs, with the industry, and I'm not sure for the time being that there is in the work, in the day-to-day work, and in the capacity that we are preparing for a crisis to occur if one day there is one to deal with, to be under this political pressure. Of course, there are some debates, but it's normal, and it's not something which is totally new for supervisory authorities. And I'm sure that Mrs. König and all the board to take the decision are able to do this in a proper and independent manner.
Thank you. Yes, please. There are some replies to that, and then we go for the final round.
Just one quick comment on what you said. Note there is a connection, right? The stronger the SRB and other regulators intervening, and the clearer the organization of the banking group is. And this is why I said we should encourage banks to organize in a holding company structure. The lower the MREL or TLAC or whatever it is can be later on, because the more credible the whole system is, right? The lower the costs of a bank failure will be, and the lower the need to have this self-insurance will be. So I think the cleaner the structure is, and the clearer to understand it is for all market participants, and the easier it is for people to price in the risks, right? The lower the costs of bail-inable debt, the lower the level of bail-inable debt that we need as a regulator. So that's the beauty, I think, of the approach, which we, because you asked for positive sides, I think we need to introduce into the debate.
Thank you very much. Tim? Yeah, I'm sorry, Tim?
Well, just to come back to 2 points I made earlier on, which I think we do address to the SRB. At their recent conference, I think they said that they are likely to be harsher than maybe would have been the case before in terms of when they intervene and by how much they intervene. So investors just want to be sure that they are treated fairly, so that we don't have a bank pushed over the cliff precipitously too early, and that the degree of the write-down isn't too harsh under internal or external pressure, wherever it comes from. In other words, investors want to be satisfied that they're not getting ripped off by the authorities, and they're not the whipping horse in this whole process. So I think that is the ask. We're not suggesting they're going to be, but we just want to make sure they're not.
Just 1 second, and sorry to again, these awful SRB people, they want to talk all the time. No, just one thing. We've got in the framework one principle to add to the jargon the NOCW, the no creditor worse off. And clearly among the things we will have to justify in our action is that if we go for a resolution, the creditors are not in a worse situation than in liquidation. Just there, so there is already something in the text which organizes the action.
So you see the body language. We don't have to give the microphone over there. Christian.
To your earlier question, I'm actually quite pleased and reassured by the fact that Gaëtan seems to be confident that the SRB can go on doing what they are expected to do. My and our collective, I think, impression of recent events may not point in the same direction, I have to say. So from our perception, starting, I think, sort of with the recent publication of the Commission's Delegated Act on MREL, we have slightly, I would say, it has slightly raised our concerns, which were already significant, about whether or not the member states were actually behind this whole undertaking. Now, for those of you who are not familiar with the contents of the Delegated Act that has been published by the Commission last week, it is conspicuous by its absence, by the absence of the reference to the famous 8% burden sharing threshold, which is essentially the participation, the collective participation of shareholders and bondholders in the losses of a bank that is about to be bailed out. That has not found its way into the Delegated Act, despite a very, very clear view expressed by the EBA that this was one of the key ingredients of that particular piece of legislation. Secondly, apart from the Delegated Act, we have also in recent days and weeks had quite a few comments from various member states about their commitment and their sort of views on the MREL, on bail-in in general and MREL in particular. Bail-in as an instrument has been called into question as recently as this morning by some of the member states. And MREL, with the 8% threshold that is already present and has been legislated on in the BRRD, in Article 44.5, in particular, has been called into question by some member states as well. So I would feel a lot less sanguine, to be honest, sort of sitting in the position of regulator about member states' commitment to this whole mechanism.
So you see, if you're a little bit of an outsider in the Delegated Acts discussions, it becomes quite complicated if you go into specifics. There was a huge discussion which is on a level which is not in the Parliament, which is not in the Council, but which is between the European Banking Authority and the Commission about a Delegated Act, about a level 2, about a minor legal form of lawmaking, because there are some specificities and there is something absent which other people would like to see in. And there was a huge battle, and there were some comments from the national governments as well, especially today and in the last days. So I count 3 questions that we would like to have an answer on. The first is for the packing order, and is that are the right ones to contribute, or are the wrong ones first? Second question is about cocoa. So Tim, maybe you can take the cocoa question. And the third one, well, assessing the bank's health. Do we start on the right or wrong food. Maybe Gaëtan is taking. Maybe we start with Tim and we continue.
Well, I mean, just very briefly, because it gets very technical very fast, but there is a conflict of interest between shareholders and note holders generically, hence why there is a need if note holders are subordinated risk takers and they get a fixed return, as opposed to shareholders who have the opportunity to ride up the capital when banks recover. That is a conflict of interest. It needs to be discussed, and that's why I say corporate governance needs to be looked at afresh. Banks don't behave in the way that companies do. They don't go bust. They go into resolution. It's a new concept for us, so we need to redesign the rules. There are some specific problems with cocoa, issues, not problems, issues around cocos. But again, look, people have bought those, and a lot of people, the investors have written, they've read the fine print. Whether they understood it or not is a question you can ask. But I think they do know there's risk in those instruments. They're not expecting the risk to actually materialize. But they know, of course, it can do. Just on the CET1 ratio, I mean, again, talk to any bank analyst, you're right, CET1 ratios don't guarantee anything in particular. If you look at Swedish banks, they have very, very strong capital ratios based on a very low risk asset weighting for mortgages in Sweden. And you can say, is that dangerous or is it not? I personally believe Swedish banks are very strong. Those ratios probably mean something, but it's difficult, and that ratio alone does not help you read a balance sheet, hence the complexity of pricing bank risk. And I don't want to get any more technical than that, but the Basel Committee is looking at risk asset weightings and trying to harmonize them, as you know, across the globe so that we get a more consistent measurement of CET1 ratios. And that is something that is probably slightly overdue, but let's hope they don't push them too high either.
Just to continue on this issue, that's right, that financial groups make their own calculation and they transmit that to supervisors, and it's the same. Resolution authorities receive some reporting, and for instance, we are working for the time being on the precise identification, quantification of all the eligible liabilities, and it is on the basis of information which is transmitted by the financial sector. We can't imagine do that by ourselves from zero. But also one of the key jobs of supervisors or resolution authorities is to monitor, to check the quality of the information which is transmitted. And supervisory and resolution powers have in particular many powers to conduct on-site visit, and it's quite often that you have public or not public sanctions which are imposed by authorities on firms because what they had declared was wrong, and that's a typical kind of cases for disciplinary procedures and sanctions. Also, you mentioned CET1. You must keep in mind that supervisors and resolution authorities don't look only on CET1. There are many ratios they monitor, and among the topics we monitor closely together, we exchange a lot with the ECB and with the different competent authorities, is clearly liquidity ratios. Because many times you've got a bank which goes to the wall and which has a fantastic CET1 and solvency ratio, but the problem is not that one. The problem is a liquidity issue. So if we miss that, we miss everything, or close to everything.
If you have the feeling that CET1 doesn't mean much to you, you will have a chance on a cocktail to talk about equitable capital and get deeper into it. We have just a few minutes ago, so that is for Christian to add something, and then we go for the final remark.
For those of you puzzled about CET1, you're not alone with that, in fact. And I should add that we have for a long time been very vocal about the usefulness or the limited usefulness of risk-weighted asset as being sort of a basis for measuring capital adequacy, which is why the leverage ratio as an incremental measure has been out there and is being consulted on. And we strongly believe that the leverage ratio as an unbiased measure or a less biased measure, but certainly not a measure sort of depending on risk modeling by the banks themselves, is a much more useful and much simpler way of looking at the health and the robustness of a bank. So to your point, we strongly believe that sort of CET1 ratios have a certain usefulness, but only when it comes in conjunction with a leverage ratio, and a leverage ratio that is adequately high. And this consultation sort of is ongoing. We strongly believe that leverage ratios of 4 to 5% are probably the appropriate level of starting. And I would also like to link this point into the resolution topic that we have discussed now for some time. It is an added quality and an added benefit of the current BRRD framework that the 8% clause in the BRRD actually builds on non-risk-weighted assets. So therefore, in a way, it's a much more robust and also a much more universally comparable and applicable measure. From that perspective alone, we strongly believe that what is enshrined currently in the BRRD, in terms of that 8% threshold, is a very sane and a very sound and robust way about A, making sure that the capital underpinning of banks is measured in a less biased way than the risk-weighted assets basis provides for, and secondly, in setting an appropriately high level of bail-inable liabilities, again, comparable across a variety of banks.
Thank you very much, Christian. So now we come to a very difficult thing. We allowed you now, panelists, for some time to elaborate on very specific issues going into Article 44 of BRRD and so on. Now, I would like to have just one sentence from everybody, a concluding sentence. We were asked to say Europe's new resolution regime, how to make it work. That was more or less the title over there. So, how to make it work? You have just one sentence, and I don't allow too much semicolons on that. Please, Georg, if you start.
Good, thank you. So my wish list, if you like, for bail-in would be the following. I think we need strong intervention powers internationally in a single point of entry regime, so operating on a holding company level for banks. We need early intervention and clear triggering rules to make everyone aware of when and how bail-in is to operate. And lastly, and this hasn't been really mentioned so far, we also need liquidity provision, ideally from a central bank, during a resolution of a bank, accompanying the restructuring, because bail-in itself is only recapitalizing the bank, but we need liquidity during these transition periods. That's my, my dream list. I wish we are on a good way towards that.
Thank you very much. Please, Christian, if you...
Now, our wish list really sort of could be much longer, but I'll try and keep it down. As you've heard before, and I think I will say it again, number one on the wish list is stick with what has been legislated. The BRRD is a good starting point, and I think any attempts to water it down should be resisted. Secondly, the resolution authorities need to be empowered to do their job properly and at the right time. And then thirdly, we still believe bank structural reform is a key element to support and enhance what's been done on the resolution side.
Thank you.
Thank you. Everything may be not perfect in the framework, in the organization of firms, etc. But I think, once again, we must take into account that there has been improvements. There may be additional improvements, but there has been already a lot. For firms, they have made some progress. Trust us, we are working to make them more and more resolvable. It's our day-to-day work. Of course, it's not to be done in one day, in 1 week, or I will not continue that way. It takes time to assess exactly what are the needed measures and to make sure that the needed measures are taken by the firm. But really, trust us that we are doing our best. And I'm not asking for a test for too soon, but anyway, we are preparing for that, and we are making sure that the firms also are preparing for that.
Well, I think 3 words: transparency, consistency, simplicity. I think those are 3 easy things to ask for. More of a debate. We need to decide what banks do and what they are. I don't think that debate's been held. And completely nothing to do with this, but because I'm a Brit, I'm in Brussels, and we're 3 weeks away from a big momentous debate in a personal capacity. If any of you have a vote, get over to London and make sure you use it to stay in, because this is where we belong, not outside. And I say that because I believe it, and I hope there are people in this room who believe it as well. Thank you.
Thank you very much, Tim. So, hope that it won't be tested too soon. You have heard a lot of problems, a lot of doubts about the system, but as well a lot of arguments in favor for implementing this system. Thank you very much for following this, what I would call a hardcore discussion. Even for me as a financial journalist, I was surprised that so many people were interested in all these details. Thank you very much for your attention, for your interventions. Thank you very much on the panel, for the panelists. Usually I interview politicians, so that was a little bit surprising, because usually I ask questions, I don't get answers. Here I ask questions, I get answers. Very concise. Thank you for that. And for that, I will conclude this panel. Thank you.